I want to tell you something I've never said quite this directly on this channel before. There is a moment, a very specific kind of moment, that I've been chasing in the most disciplined and patient way I know how, for the better part of my adult life. Not chasing in the reckless sense. Chasing in the sense that you spend years building the observational toolkit to recognize it when it appears. Years studying the conditions that precede it. Years stress testing your own pattern recognition so that when the moment actually arrives, you don't second guess it into paralysis. I've experienced that moment a handful of times, not many. The genuinely consequential ones are rare, which is precisely what makes them consequential. And each time it arrived, the external environment looked nothing like opportunity. It looked like confusion, like noise, like the kind of situation that most sensible people would look at and say, "Not yet. Wait for more clarity. This isn't the moment." That instinct, the instinct toward caution in the face of confusion, is not irrational. I want to say that clearly. It comes from a very reasonable place. But in my experience, acting on it at the wrong moment is one of the most reliably expensive mistakes a long-term investor can make, because the clarity almost never arrives before the window closes. I'm recording this video today because I believe, with a level of conviction I want to be precise and honest about, not inflated for effect, that one of those moments is in front of us right now. Not identical to what I've seen before. Nothing ever is. But structurally similar in the ways that I've learned, through both study and experience, matter most. I want to walk you through exactly what I'm seeing. And more than that, I want to walk you through the framework I use to evaluate moments like this one, because the framework is more valuable than any specific conclusion I could hand you. The framework is what makes the next one recognizable too. Let's get into it. Here is something I've noticed about every genuine, significant investment opportunity I've encountered over the years. None of them were obvious at the time. I don't mean that in the smug, retrospective sense, the "of course it was obvious in hindsight" kind of observation that tells you nothing useful. I mean something more specific and more actionable than that. I mean that the genuinely consequential opportunities, the ones that over the relevant time horizon produced outcomes that were dramatically different from what the average investor experienced, were almost universally invisible to the average investor at the moment they were most accessible. Not because the information wasn't available. In most cases, the information was entirely public. The data was there, the logic was articulable, the pattern was recognizable if you knew what to look for. But most investors weren't looking for it. They were looking at something else. They were following the thing that had everyone's attention, the exciting thing, the discussed thing, the thing generating the most narrative energy in the media environment. And while their attention was there, the actual opportunity was sitting quietly somewhere adjacent, largely unexamined, priced as though the future it was pointing toward didn't exist yet. This is not a coincidence. It's a structural feature of how information flows through markets. Markets are, among other things, attention allocation mechanisms, and human attention is deeply finite. At any given moment, most of the available attention is concentrated on a relatively small number of things. The things that are loud, fast-moving, emotionally engaging, and easy to discuss in 30 seconds or less. Everything else, including many of the things that actually matter most for long-term wealth creation, operates in relative obscurity. The implication of this is something I've built a significant part of my investment approach around. The quality of an opportunity is inversely correlated with the amount of mainstream attention it's currently receiving. Not always, not as an absolute rule, but as a probabilistic tendency, it's remarkably consistent. The things everyone is talking about are almost always fully priced for the optimistic scenario. The things nobody is talking about, or that are being mischaracterized because the dominant narrative hasn't caught up to the underlying reality yet, that's where the genuine asymmetry lives. What I'm seeing right now fits that description, and I want to explain exactly why. Let me draw a distinction that I think is critical, and that I think most investors, even thoughtful ones, consistently blur in ways that cost them significantly. There is a difference between identifying a correct trend and identifying the correct way to be positioned for that trend. Getting the trend right is actually not that hard. The biggest secular forces shaping the global economy, the transformations that are going to compound over decades and reshape entire industries, these are not secret. They're knowable. They're discussable. The difficulty is not in identifying them. The difficulty is in translating the correct identification of a trend into a positioning decision that actually captures the value that trend creates. And here's what I've found consistently over many years of studying this problem. The most obvious way to be positioned for a correct trend is almost never the most profitable way. The reason is straightforward. The obvious play, the thing that maps most directly and legibly from "this trend is real" to "therefore buy this," attracts the most capital, the most attention, the most competition. It becomes crowded. And crowded positions, regardless of the correctness of the underlying thesis, tend to deliver mediocre returns precisely because so much optimism has already been priced in. The best positioning, the positioning that produces the kind of returns that are genuinely life-changing over the relevant time horizon, almost always involves stepping back from the most obvious expression of the trend and asking a different question. What has to be true for this trend to continue? And what are those things currently priced as? That's the question that matters, not what is the trend. But what are the necessary preconditions for the trend, and how is the market currently valuing those preconditions? When you ask that question honestly, when you actually look at the businesses that the trend cannot happen without rather than the businesses that the trend might benefit, you often find something interesting. You find businesses with genuine, durable structural advantages, businesses with pricing power, businesses with the kind of compounding earnings profiles that, held over the right time horizon, produce outcomes that the obvious play almost never delivers. That asymmetry between what the trend needs and what the market is currently paying attention to is where I'm focused right now. I want to spend some time on the lessons rather than the specific conclusions, because I think the lessons generalize in ways the conclusions don't. Every significant investment position I've held that produced exceptional long-term returns had a specific set of characteristics at the time I first took a serious interest in it. Not all of these were present in every case, but most were, most of the time. The first was that the business occupied a position in its value chain that was structurally non-optional. I mean this in a precise sense. The businesses or processes that depended on it couldn't easily substitute something else without fundamentally changing what they were doing. Non-optional positioning is the foundation of durable pricing power. And durable pricing power is the foundation of the kind of long-term compounding that actually changes financial outcomes. The second was that the business was being evaluated by the market primarily through the wrong lens. This is hard to recognize in real time because the wrong lens often seems like the obvious lens. But when a business is being priced as though its most important characteristic is its current earnings multiple, while its actual most important characteristic is its compounding positioning in a structurally growing market, there's a gap, and that gap over time closes in favor of reality. The third was that the near-term narrative around the business was either confused, negative, or simply absent. Not because the business was deteriorating, but because the market's attention was elsewhere, or the story was complex enough that the shorthand version of it didn't travel well through the dominant media environment. When all three of those conditions were present simultaneously, non-optional positioning, wrong market lens, confused or absent near-term narrative, that combination was, in my experience, the strongest possible signal that I was looking at something worth very serious attention. Right now, when I look at the landscape of businesses sitting at the intersection of the most important structural trends of the current era, I see that combination present in multiple places simultaneously. Not in the obvious places, not in the things generating the most discussion, in adjacent, less examined places that the market's attention hasn't fully caught up to yet. Let me give you the framework I use, because this is, I think, more valuable than anything else I could offer. When I'm looking at a potential long-term position, when I'm trying to decide whether something deserves serious capital allocation over a multi-year horizon, I run it through three fundamental filters, in order. Filter 1, is this business structurally necessary? I'm not asking whether the business is good or whether the management is smart or whether the product is well reviewed. I'm asking something more fundamental. Does the thing this business does need to happen? Not, is there demand for it right now? Demand is cyclical. But is there something about the structural evolution of the relevant part of the economy that makes what this business does increasingly, not decreasingly, necessary over time? This filter eliminates a lot of things that seem attractive on other dimensions. A business can have great margins, great management, and great current momentum, and still not be structurally necessary, which means its advantages are always at risk of being arbitraged away by a competitor or made irrelevant by a structural shift. What survives this filter is usually a much smaller set than most investors start with. And that smaller set is where the serious work begins. Filter 2. Does this business have a widening moat or a narrowing one? This is the question most investors think they're answering when they evaluate competitive positioning. But in my experience, very few people answer it rigorously. The question isn't, does this business have advantages? Almost every business has some advantages. The question is whether those advantages are getting stronger or weaker over time relative to the dynamics of the relevant market. A business with a widening moat, where the structural forces of the industry are actually reinforcing its competitive position rather than eroding it, is a fundamentally different animal from a business with a static or narrowing one. The valuation math is completely different. The appropriate time horizon is completely different. The right behavior during periods of price volatility is completely different. When I find a business that passes filter 1 and also has a demonstrably widening moat, I'm very interested. That combination is rarer than most investors appreciate. Filter 3. Is the current price reflecting reality or narrative? This is the filter where most of the actionable opportunity lives, because businesses that pass the first two filters are often correctly identified as high quality by the market, which means they're often not cheap in the traditional sense. The question is not whether they're cheap. The question is whether the price reflects the most probable long-term outcome, or whether it reflects a narrative, either too optimistic or too pessimistic, that has temporarily disconnected from the fundamental trajectory. When the price is reflecting a temporarily pessimistic narrative about a business with structurally necessary positioning and a widening moat, that's the specific combination I'm most interested in. That's where the asymmetry is most favorable for the patient, long-term investor. And right now, when I apply those three filters to what I'm seeing in the current landscape, I find that combination in places that most investors are not currently focused on. I want to be honest about why I think the current moment deserves particular attention, as distinct from the general principle that good opportunities always exist somewhere if you look carefully enough. There are moments when the gap between where market attention is focused and where the actual structural opportunity is located is unusually wide. These moments tend to cluster around periods of genuine disruption, when something new is happening quickly enough that the market's attention is absorbed by the most dramatic and visible expressions of the change, while the less visible but more structurally fundamental implications are being processed slowly or incompletely. We are in one of those moments. The transformation currently underway in the global economy, the specific combination of technological, geopolitical, and structural forces at play, is producing a landscape where the obvious narratives are capturing nearly all of the available attention, where the most discussed investments are the most examined and therefore the least likely to deliver the kind of asymmetric returns that meaningfully change financial outcomes. And simultaneously, sitting adjacent to those obvious narratives, there is a category of businesses with genuinely non-optional positioning, genuinely widening moats, genuinely structural earnings compounding, that are being priced as though the full implications of the transformation are not yet being applied to them. That gap between where the narrative attention is focused and where the structural fundamentals are actually pointing tends to close. Not quickly. Not linearly, but over the relevant investment horizon, the fundamental reality of a business with non-optional positioning in a structurally growing market tends to reassert itself in the price. Being positioned before that reassertion, before the gap closes, before the market's attention catches up to where the structural value actually is, that is what I mean when I say this moment is significant. Not buy everything now. Not the bottom is in. Those kinds of claims are not things I make because they're not things anyone can know with the precision required to act on them responsibly. What I mean is something more measured and, I think, more genuinely useful. The conditions that historically precede the most significant long-term wealth-building periods are present right now, in specific and identifiable ways, for investors who are willing to look past the dominant narrative and apply the kind of patient, framework-driven analysis that I've described. I've been doing this long enough to have made serious mistakes. I want to talk about what those mistakes have in common because I think it's the most useful thing I can share. Every significant mistake I've made as an investor had the same root cause. Not bad analysis of the specific business, not bad timing in the conventional sense. The root cause in almost every case was a failure of framework, a moment where I let something other than my analytical process drive a decision. Sometimes what drove it was the excitement of a narrative that I found compelling on an intellectual level, but that I hadn't rigorously filtered through the 3 questions I described earlier. Sometimes it was social pressure, the ambient confidence of people I respected pointing in a direction that my own process hadn't fully validated. Sometimes it was impatience, the discomfort of watching a position move against me before the thesis had time to play out. In every case, the corrective was the same: return to the framework, not to a different framework, not to a better piece of information. To the same 3 questions, applied more rigorously with more honesty about what the answers actually were. The investors I've watched build genuine, durable wealth over long periods of time share one characteristic more consistently than any other. They have a framework that they trust enough to follow even when following it is uncomfortable, even when the dominant narrative is arguing loudly in the opposite direction. Even when the people around them, sometimes smart people, sometimes people with impressive credentials, are making confident arguments for why the framework doesn't apply to this particular situation. The framework always applies. The situation always has a unique surface. But the underlying mechanics of how businesses create value and how markets price that value over time are remarkably stable. Building that framework, genuinely building it from the inside in a way that you actually trust when it's being tested, is the work. It's not exciting work. It doesn't make for good headlines. It doesn't generate the kind of social media energy that more speculative approaches produce. But it is, in my experience, the only approach that produces the kind of results that actually matter over the time horizon that actually matters. Before I close, a few things briefly. First, I've prepared a document that walks through the specific framework I described today in detail, the 3 filters, how to apply them to individual businesses, and what to do when the answers are ambiguous rather than clear. It's in the description. It's completely free. I'd encourage you to read it seriously and apply it to your own thinking, not just accept my conclusions. Second, if you want to go deeper, if you want to build the kind of systematic, principled approach to long-term investing that holds up under real market pressure in real time when the noise is loudest, I've built a community of serious investors around exactly that work, not a stock-picking service. A genuine community of people who are committed to doing the intellectual work properly and building real conviction through rigorous analysis. The details are in the description. Third, if this kind of thinking resonates with you and you want more of it, subscribe. I'm not going to stop having this conversation. The next significant moment will come. I want to be here for it with you. Let me come back to where I started. I said there are moments, rare, structurally specific moments, that I've spent years building the toolkit to recognize. And that I believe we're in one of those moments right now. I want to be precise about what that means and what it doesn't mean. It doesn't mean that everything will resolve quickly or cleanly. It doesn't mean that there won't be more volatility, more uncomfortable headlines, more periods where the short-term price movement argues loudly against the long-term thesis. There almost certainly will be. What it means is this: the conditions that historically create the most favorable long-term entry points for patient, framework-driven investors, the conditions where the gap between market narrative and structural reality is widest, where the asymmetry between risk and reward is most favorable, where the businesses with genuinely non-optional positioning are being priced as though the full implication of their structural advantage hasn't been recognized yet. Those conditions are present right now. And the investors who will look back at this period as one of the defining chapters of their financial lives will be the ones who did the work, who applied the framework, who held their conviction through the noise, who understood the difference between a narrative getting disrupted and a business getting disrupted, who were patient enough to let the fundamental reality of great businesses reassert itself in the price. That's the opportunity. That's what "this is even bigger" actually means. Not louder, not more dramatic. Bigger in the specific sense that the structural forces at play and the businesses positioned to be the necessary infrastructure of those forces represent a compounding opportunity of an order of magnitude that I haven't seen quite this clearly since the last time I felt this way. Do the work. Apply the framework. Build the conviction that holds when it's actually tested. I'll see you in the next one.